Hey, what's going on, everybody? I am here with my co-host Keith. Keith, what's happening, brother?
What's up, my guy? How are you?
I'm good, man. So today on the Integrated Entrepreneur, we're going to go over how to get equipment for your business, and ultimately how to utilize and set your business up for future growth, making sure you get the right types of financing. Okay, and I can't stress enough how important this is. This is a make or break. All right, most equipment financing deals fall apart because of the vendor. Okay. So I'm going to give you guys some step by step action items. This is all going to be action packed. So take a lot of notes. And Keith is going to go through the planning and tax strategy standpoint of this for you guys live. All right. So, first off, one, make sure you pick the equipment that is going to have the greatest amount of benefit to your business. Okay. So, the reason I say this is I constantly am asked the question, should I get new or used? Should I get the top end model or should I get one that, is a base model plus? All right. And I'm here to tell you it really doesn't make a difference if it's new or used. There's a couple extra steps if it's used. Uh, and it doesn't matter if really for the most part, if you get approved for 50,000, you should get approved for 60 or 70,000 for equipment. If you get approved for 200,000, you should get approved for 250 or 300. So the differences in what most people ask for when they're going to buy equipment are so small. I want you guys to understand, always get the piece of equipment that it is going to produce the most revenue for you or help your company the most. That's first and foremost what matters. Second, you guys have to pick a vendor. Actually look at vendor reviews. Okay. I cannot tell you how many times I have gone to finance something for a client. I get the invoice and we get everything in place. And now that piece of equipment was sold out from under them. All right. There has been an incredibly tight equipment market the last, call it basically since COVID. Okay. Since the pandemic. And the
Mm-hmm.
reason for it is people were still needing to buy equipment. They were still essential. It never slowed down. Some of the equipment did slow down. Some of the shipping did slow down. It's now getting caught back up. All right. So when you go to a vendor, write this down. You need to get the front and you need an invoice. That invoice typically needs your address, your business name, the purchase price, the date, what's included, the serial number, the make, model, year of what you're buying. And if it's used, you just need to get a purchase and sale agreement with all that same information. Now, once you've reviewed vendors, okay, or dealerships, whatever you want to call them, and you know you have the right one, then you want to go in, negotiate for the equipment, okay, as if you're buying cash, and then ask for an invoice. And then you want to leave a deposit. I can't stress enough the importance of leaving that deposit. This way, the equipment doesn't get sold out from under you. The deposit needs to be reflected on the purchase and sale agreement or the invoice. I know this is really boring, but this stuff, if you're listening to it, it's going to save you a lot of money and it's going to save you a lot of headache. All right. Then, after you have all that, you can go to a bank. You could go come to me. You could go anywhere that does equipment financing. You fill out a one-page application, send in 3 months of banks, a tax return, a driver's license, a voided check, and an invoice and purchase and sale agreement. With that, they should be able to spit out options for you in 24 to 48 hours. All right. After that, should be a smooth and easy process. Couple things to note. When you get the invoice, if it's titled equipment, you want to get a copy of the front and back of the title. If it's brand new, you want to get the front and back of what's called the MSO, which that's what most dealerships work on. They don't work on an invoice. They'll say MSO. So just ask for the MSO. All right. That in and of itself is 80% of the battle, what we just went through. Okay. Now, you have to understand, and this is where Keith is going to come in to explain this. There's three types of options, okay, when you're financing equipment. You can purchase it and do a straight finance that'll be 3 to 6 years, all right, on new. On used, it'll be a shorter term, probably 2 to 5 years. You can do a lease with a dollar buyout. If you do a lease with a dollar buyout, that is going to match the cost of capital everything, the term, the payment, that is going to identically match with you purchasing it. So I want you to understand there's no difference between doing an equipment purchase or doing a lease with a dollar buyout if done properly. There are tax advantages to both of those, which Keith will get into. The third one is just a straight up lease, and I would never tell you to lease a piece of equipment. You want it on your own balance sheet because it's valuable to have. It makes your company worth more, and if you ever want to sell it, now you have an asset to sell, or you can actually borrow against it when it's paid off. All right, so Keith, I want Keith to kind of go over some of the tax advantages and some of the planning between doing a straight finance option and a lease with a dollar buyout.
Yeah, the two main components, right? And this is, a timely conversation being that it's the end of the year and every, how should I say this? Well-educated CPA is going to give the almighty advice of go buy some shit.
Yeah.
Right. So every car dealership in the world is excited to this time. Every equipment financing guy, it's just really, it's the right time to have this conversation. Here's the reality. To me, that it's the same thing. Lease with an option basically is an open-ended lease. It's almost identical as you buying the damn thing outright. Right. So one, you can deduct the payments. Right. This open-ended lease is kind of the same way that I bought my Ferrari. Right. X amount down, X amount per month in the payments, 5-year term. At the end of the 5th year is a balloon payment. Right. Dollar buyout, balloon payment, same damn thing. So for me, that made sense to lease it because it doesn't meet the 6,000 pound vehicle for the Section 179. So the only other way to get some tax, I won't say the word avoidance, because that would be illegal.
Relief.
To mitigate some tax, right? We're doing the open-ended lease because we can deduct whatever our tax rate is off of that monthly payment. So if your monthly payment's $5,000 and you're in the 30% tax bracket, 30% of that's deductible. So you're getting some reprieve from taxes if you do the lease with a buyout. Now, on the other hand, I'm more partial to this one for now, is being able to utilize Section 179, right? And that's a bigger savings for you up front because you're able to take that 5-year term and smash all of the depreciation into that first year, right? And or bonus depreciation, depending on what year you use that, knowing that that's going away. So that realistically, you're buying heavy equipment and not, I guess, let me put some parameters around that. There are implications on what you can buy to utilize Section 179.
Yeah.
Right. So like the Ferrari doesn't weigh enough, right? Vehicles have to be 6,000 pounds. Equipment has to be a specific type, right? Heavy machinery or computers or, so you can't just go buy some random shit at the end of the year and hope to God that you can utilize these things. So the reality is, I think it's it's not a or an and conversation. It's or. It's a matter of when you're buying it and what your current tax position looks like, and what opportunities make the most sense for you to do. Like, I had a call today with a guy. He's like, "Hey, I want to deduct the vehicle we bought this year," and I'm like, "You're getting a tax return. There's nothing to deduct. Like, what are we going to write off? There's no point, right?" So also be careful because you don't want to just nut up and buy a bunch of shit at the end of the year and then turn around and realize that, man, I bought all of this for nothing because I can't really utilize the deduction to help me do anything.
Yeah.
So there are some Q&A session to be had with your CPA prior to making purchase on that side. But to your point, as far as which one makes the most sense, I think it's just we got to look at your current financials and determine which one's going to give you the best bang for your buck.
As a professional, I want to ask this question. On a lease with a dollar buyout, when you actually take possession of that, how does that change taxes in that last year?
It doesn't, because your loan's paid up by that time. So the only thing that happens is like it's like $108,000, I think, is my last payment.
Yeah.
If I keep the car, right?
Yep.
I can also go sell the damn thing.
Yeah.
It's not like you leasing a truck or a Porsche from Porsche.
Yep.
They don't want it back. They'll buy it back, but you're going to get the raw end of the deal, right?
Yeah.
But they don't want it back, right? They're not servicing it. They don't really care. They just financed it to you. So the reality is that last payment is just a bigger deduction because you're making a bigger payment in that year, and you're just it's not a credit.
Yeah.
It's just
but when you're buying it back for $1, let's say I have a vehicle, right, a work truck. It's 70,000. Okay, I do a lease with $1 buyout. My payments are $750 a month, and in that last year, that fifth year, I go and buy it for $1, but it's probably worth 40,000 or 30,000. So how does that work on taxes? Because I've always said, hey, when you're deciding this, speak to your accountant. I can run the numbers either way. It's going to be the same thing.
Yeah.
How do I articulate what that does in that last year?
Depends on how you write it off. If you depreciated it all in year one, there's going to be some clawback in your taxes, right?
That's what I meant. Yeah.
Yeah. You're gonna owe a little bit of that tax dollar back, but the reality is it's such a minute number that your CPA should be able to figure out some planning strategies to get around it, right? Or to make it unnoticeable.
Okay.
On the lease, and so that's the reality. Otherwise, there's really not much that you should be concerned with. Also, let's talk about that. How many times in your life have you kept a car all 5 years you paid on it?
Once.
Right.
Yeah.
So
out of a lot.
Point.
Yeah.
Mute point, right?
Exactly.
It's one of those things. It's like you're going to sell this in year 3 for the newer model, and you're going to make some money on it, and we're going to call it good. And you might have a little bit of a tax issue to compensate for, but the reality is the owable tax on that will be way less than the money you made off of the sale.
Yeah.
So it just depends on how you structure it and what you're trying to get at. It's just like anything else. It's like investing in the stock market. Well, what's your goal?
Yeah.
That'll dictate how you should invest.
Yeah.
Right? What's your goal with this financing? What's the goal with the equipment? What are we doing?
Yeah.
Does the equipment make you money over the 12 years you're going to have it, the 2 years or the 8 months or however long you keep it? Right? Or is it not?
Yeah.
Right. So these are all things that should be discussed prior to deciding which way to go.
100%. And I'm gonna add a couple other things here, guys. One, when you use equipment, first off, you should always finance equipment. You should never pay equipment in cash. Cash is king. I don't care what anybody says. Cash is king, and it can be used to grow your business as opposed to buying a truck and then being stuck with the truck, right, and not have that cash, because then you have to go borrow, and it's going to be more expensive than the financing you would have got on the vehicle or the piece of equipment. All right, so one, always finance anything over 10,000. Okay, for that reason, cash being king. The second reason is this: you need to build your business credit. Okay. When you finance a vehicle personally, it goes on your personal credit report. When you finance any equipment, including vehicles, under the business, it goes on your business credit. What that does is, as soon as you make 12 payments on it, it counts towards quote unquote comparable debt. All comparable debt does is show you or show an underwriter that, hey, you've paid off successful financing in the past. And typically, let's say I have 700 credit, my business is doing $2 million a year, and I finance a truck for $100,000. If nothing changes after I make that 12th payment, I'm still doing $2 million a year. My credit's still 700. I should be able to qualify for 1.5 to 2 times my comparable debt. All right. So because I financed that truck for 108, that means I should be able to get anywhere from 150 to 250,000 in equipment financing if I need it after that 12th payment. All right. That is another reason, because I have seen clients with amazing businesses that never financed equipment before. And then they struggle or they don't get the terms they should have because they had no comparable debt. So that's why anything over 10,000, you guys should be financing. Okay. It's easy. You'll have a low monthly payment and you can pay it off at any time if you choose to, but finance it, build the business credit, build your comparable debt, and actually make a foundation that is very, very easy to lend to. Okay. In challenging times and in great times. It's your job to build up your business profile, and nobody teaches us this in school. That's why we're teaching it to you here. Keith, you got anything to add to that?
Yeah, you just gotta, here's the thing. Leverage is the game changer for a lot of people once they understand how to leverage it correctly.
Yes.
So here's what we talk about. Finance everything versus cash buyers. The old Dave fucking Ramsey, right? Here's reality. If I'm sitting on 150 grand and I need to go buy a skid steer, and that's going to cost me 5%, where can I put that 150 grand in cash that can produce the same amount as my cost on that same dollar? Well, Luckily for everyone today, banks are offering fucking 97% goddamn interest rates because they're trying to collect everyone's money, right? I think 5%, right, or 4.8, 4.9% high yield savings accounts. So I'm parking my money in the savings account, letting the bank pay for the cost of the financing of the money that I borrowed from Jonathan. Plus, the skid steer is going to produce profits to me every month when I put it in service.
Yeah.
So that's just a small workaround on how to really leverage your liquidity. And then there's other avenues. There's the whole infinite banking model that people talk about. There's corporate investment accounts that you can utilize and get lines of credits on. There's your bank line of credit, your home equity line of credit. All of these are different opportunities for the business owner to leverage someone else's money for their capital to stay liquid.
Yep.
Right? And be in the bank.
Yeah.
And so if you can do both of those things, and now the financing costs me $0, but it's actually making me money, and my 150 is still in the bank, so I can go deploy that on something different.
Yeah.
It's a win-win-win-win-win-win all day long.
100%.
So you have to find opportunities in your business every single day to leverage that plan on every dollar you can.
Yeah. Absolutely.
So that's the game. And realistically, man, it's the way that, listen, we're in a recession. I don't feel it.
Yeah.
And I don't say that to be cocky, but I'm liquid. Right? I'm liquid. Yeah. Now you look at my debt service, you'd be like, oh my God, you got a lot of debt. Right. But my debt's making me money.
Yeah.
Right. And it's not costing me a monthly payment. It's making me money. So when you can strategize it correctly, it's actually another stream of income.
Yeah.
Instead of a cost.
Dude, good debt versus bad debt.
That's all. You just got to look at the goal. It all goes back to what you're trying to accomplish and reverse engineering that to figure out the best opportunity for the dollar. It's no different than real estate investors.
Yep. I was just going to say that.
Hard money loans versus commercial, your traditional FHA.
Yeah.
Well, shit, if I can borrow 15% off the books money that doesn't count towards my debt to income, and the deal can pay for the 15% plus give me some profits and cover the expenses, well, shit, I'm going to use 15% money all day long.
Yeah.
Because the reality is in 6 months, I'll go refinance that person out of the deal. And now I've acquired a piece of property that it's cost me $0 of my own money that now I'm getting all the income on.
Yeah.
That's the ticket.
This is a masterclass right here. All right. Do us a favor. Share this with someone that needs to hear it. Leave us a review. That's all we ask. All right. We're going to keep these coming every single week for you to help grow your business, be a better person, be a better leader. All right. That's what we're here to give back. Just all we can ask is give us a review, share this with someone that needs to hear it, and we will catch you on the next one.